All right, everyone, welcome back to Money Show's virtual expo for accredited investors. I am pleased to turn this next session over to Kim Ann Curtin, the founder of the Wall Street Coach. She will be introducing a very special guest we have today as well. Kim, thank you so much for being here. It's always a pleasure.
Thank you so much for having me. I'm excited for investors today, especially since we've just had 2 days of testimony from Jerome Powell to have you have the chance to hear Team Doomberg. We have the head writer with us today. And yes, he has a Chicken Little as his anonymous face. This is an amazing collective of very smart human beings. Team Doomberg is an anonymous publishing arm of the bespoke consulting firm, providing advisory services to family offices and suite executives. Its principals applied their decades of experience across heavy industry, private equity, and finance to really deliver innovative thinking and clarity to complex problems. They were launched in May of 2021, Doomberg, to highlight the fundamentals that are really missing from many economic and policy decisions. And it has quickly grown to be one of the most widely read finance newsletters on Substack, and have over 250,000 followers on Twitter. People listen to you, Doomberg. Thank you for being here.
Kim, man, thanks for having me. Big fans of your work and looking forward to a fascinating 30 minutes together.
I agree. And how perfect the timing is, considering Powell has just, given us so much information in a short amount of time, just 2 days. I'd love to start with that. Your take on what investors really want to walk away with from what he has said and what he hasn't said.
It's fascinating because we have experienced over the past, let's say, 6 to 9 months, an ongoing pattern of Jerome Powell comes out and says he's very serious about slaying inflation, acts accordingly. The market originally reacts to that in a negative way. Growth stocks sell off, inflation sensitive equities have a hard go of it. And then once those headlines dissipate, the market begins to doubt that Powell actually will see things through. And we see a rush back into speculative stocks and pick your favorite market, leading indicators of speculation that everybody knows exist. And they sort of begin to start calling his bluff. And then weeks go by and Jerome Powell has another opportunity to either, make an interest rate decision or to address the market via, in this case, testimony before Congress. And he reiterates that he means what he says and he intends to walk his talk. And so that's what happened again this week. I think the market, was expecting a 25 basis point move in inflation, and the sort of futures curve of interest rate expectations was still pricing in a pivot sometime in the near future. And Jerome Powell came out and was extraordinarily hawkish in his testimony, which is utterly consistent with everything he has said up until this point. And yet, once again, the market didn't quite believe him. I would say that after yesterday, we are grappling with 2 questions as a team. One, will we see the return of speculation as the echoes of his testimony dissipate in the days and weeks ahead? Now, it's a bit of a truncated time period because we do have the interest rate decision coming up, and the market has, I think, correctly repriced basically a 50 basis point move. But then second, if we had told you a year ago that the 2-year treasuries would be trading at 5% and that the economy didn't break, you would have been surprised. We would have been surprised. I think many people would have been surprised if we told you that on March 8th, 2023, the 2-year note's trading at 5%, and we told you that last year. You would think major recession, massive waves of layoffs. Now we've seen some layoffs, especially in the tech sector, but one wonders if we take Jerome Powell at his word and as sort of an axiom to a deductive reasoning exercise, the recent history is that we should, then how close are we to the abyss in the economy? And should we begin thinking about Powell's willingness to put up with a sustained recession in order to break the back of inflation? Because clearly the speed and depth of these interest rate hikes have not yet brought inflation down to levels that he is comfortable with. And for proof, we need look no further than the hawkish nature of his testimony in the past few days. So that's our view. There's some very interesting market phenomenon and psyche to observe. But the most consistent thing in the past 6 to 9 months is Jerome Powell has been telling the market, I'm serious about this and I'm going to do what it takes. And the market consistently gets surprised when he says it, when he reiterates it, and then pokes the bear a little bit by heading right back into zero-day options, and all the speculative stock names seem to do well a week or two after he's done talking. So that's our view.
It kind of reminds me of parents who scold their children and then their children are like, maybe he doesn't really mean it.
Yeah, pressing their luck on the time at which they come home after a party. This is
Exactly. Maybe they're not going to be that mad, or they'll get over it in 20 minutes. Tell us your team's take on inflation. What do you feel is the real story on inflation?
So there's realized inflation that consumers feel and the behaviors that instigates. There's measured inflation that governments report and the investor response that those reports initiate, and they're separate things. It's obviously the question of the day. It's the reason why this entire conference exists. There's no sort of magic bullet or easy answer. Inflation, like any other sort of measurement, really comes down to flows. And so there are flows in the economy that are, stoking inflation, and there are flows in the economy that are relieving inflation. And then you try to model the breadth of those flows in aggregate. And the classic mistake of an analyst is you're missing one important one, or you get an important one wrong. And so the integral of all of your assessments gives you an incorrect answer. The most dominant flow, in our view, that the market may be underestimating and may be a key reason why Powell remains hawkish based on the data he's seeing, is the complete 180 in China and the speed with which President Xi and the CCP totally abandoned their dynamic zero COVID policy. And we're not China experts, and we've said many times, any Western analyst who claims to be you should take a close look at, because it's a black box, right? To the Western analysts, China's a black box. We have some experience in China. We have a pretty extensive Rolodex of contacts over there, but all of our friends in China said the pivot of the propaganda was unlike anything they'd ever seen.
Wow.
And to us, that meant reopening would be violently fast, and that they would, the CCP became prepared to suffer the medical consequences of what a rapid reopening would entail. And they seem to have managed that. Now, whether they've covered it up or whether it's way worse on the ground, that's hard to say. But for the investor, the most dominant inflationary flow is the speed with which China is reopening and what that means for oil, for example, and other commodities. And that pulse that we all saw here when we reopened, we know what that pulse typically entails, but I would say China was closed for far longer than we were. And if the analogy that you would use is trying to hold a beach ball under the water in a pool, they held that beach ball far more below water than we did, and for a far longer period of time. And so, this pulse that we anticipate that we'll see could be pretty significant. There are disinflationary flows, and those are real, including a slowdown in the economy. If you look at some of the macroeconomic data that people are putting out there, it does seem like we're on the cusp of a significant slowdown. And so it is hard to model how those flows will balance out. Clearly, Jerome Powell, who has a lot of resources at his disposal, believes that inflation will be higher for longer. And so as a consequence, I think the market needs to be prepared for interest rates to be higher for longer, to use a perhaps overused term in this environment. So that's our view. So the one sort of price that we're watching the most closely as a swag leading indicator of inflationary pressure is in fact the price of oil. Natural gas is very geographic and highly inelastic, even more so than oil. Oil is a pretty good indicator of robust economic growth. And so that's the price we're watching now. And it's $75 a barrel roughly when we're talking today. That's pretty elevated historically. And that's before the full weight of China's reopening hits the market. So that's our one milestone that we're watching closely for inflation.
And do you have an estimate on that beach ball coming up and out of that ocean? What's your guesstimate time-wise?
So I think we're seeing it. And then the question becomes, how long is the lag of that pulse, into our markets? And again, even within China, there are sort of forces that are running against that, like the housing sector or the real estate sector generally. Same in the US, of course, with mortgage rates above 7%. That can't be good for a huge part of the economy, which is clearly, first-time home buyers haven't had it this bad in a very long period of time, with elevated prices and elevated mortgage rates. And so we shall see. We are in the camp that it has to be that the speed of these interest rates and the lagging, historically, it has had a lag on economic activity. We would be, if you pushed us, in the recession camp in the next 3 to 6 months. But the big unknown, again, is the net effect of China's behavior and how inflationary that might be. And then the wild card of all wild cards, of course, is if peace could be achieved in the Russia-Ukraine conflict, then that changes everybody's chess pieces, which is sort of sitting on the board today.
Do you have any indications about whether that is likely in the next 6 to 9 months?
If you're referring to the Russia-Ukraine conflict, that this is well outside of our scope of expertise. If you asked me for our hunch, we would say that we are seeing more signs of escalation than de-escalation. And I would say, according to some of the comments coming out of the most senior leaders of the Chinese Communist Party in the past few days, pretty harsh commentary about US leadership and their role in geopolitical tensions. If you were sort of trading war as a security, you'd probably want to be long it. And so I only mentioned that peace could break out as a sort of game changer because obviously I think the base case is that it won't. And when you're trying to forecast where markets will go, you're trying to look for areas where the market might be getting it wrong, and you could position yourself accordingly. But if you pushed me, we would be in the consensus view that, especially with this move away from the dollar, this attempted move away from the dollar from the BRICS countries. As a general rule, historically, when there have been major moves against the dollar, magically, coincidentally, war usually follows, and so this is an area that we've been watching very closely.
Yeah. I'm just curious, what do you feel are the areas that investors should be paying more attention to, perhaps, than they have at the start of this year? Is there anything that is just so obvious to you and your research that investors likely are perhaps not paying as close attention to as they should?
Actually, it's funny you should say that, because in a different setting, we did say that we believe, even though we are skeptical on the proposed solutions to climate change as to whether or not they're the ideal proposed solutions, we do believe that the deluge of money, which is an inflationary flow that the Inflation Reduction Act is set to hand out into these sectors such as solar and wind and so on, the deluge of money is perhaps being underestimated by investors. And we have been, we have a pro tier at Doomberg, and we did a whole presentation recently on our collective view on all aspects of alternative energy: wind, solar, nuclear power, batteries, carbon capture, sequestration, you name it. And in that presentation, we covered the pros, the cons, and the propagandas surrounding each of those technology verticals. And we ended it by saying, whatever you think should happen, you always must be mindful of what will happen. And one thing that will happen is a fire hose of government cash is going into progressive environmental favorite industries. And a lot of that money will be wasted. Some of that money will be put to productive use. But from an investor perspective, you need to be aware of just how much money is going into that sector, and the opportunities that present themselves in various forms, we think hasn't really fully been internalized yet amongst the investor class. And I would probably argue that many of the people who are concerned about inflation, the overlap in the Venn diagram with people who are skeptical about renewable energy is probably pretty high, and that they should put their ideological concerns to the side and look as sort of a raw investor hat on and say, where can I position myself to benefit from this flow of cash that I might disagree with and don't think should happen, but it will happen. And so what should I do accordingly? And then that is sort of perhaps a counterintuitive or an unexpected answer from our team, because we have written critically about many of these technologies.
Yeah.
But we are realists, and we understand that there's going to be a deluge of cash. They're pouring gasoline in these sectors, and many of the inputs into these sectors are highly inelastic. And so you could see massive price swings for the shovels that the gold miner needs to get going. Like that's the classic: sell shovels to gold miners in a gold rush. Find that high barrier pinch point in the wind sector or in the solar sector and find the company that has the solution, and they can extract an enormous amount of value from that chain, and there's no shortage of money coming into it. And so that is my answer to your question of what are people potentially overlooking.
I just so dig that answer, because that is, I imagine, such a blind spot for investors, is what should happen versus what is happening. And that is probably one of the more powerful things I've heard you say. And I look forward to that conversation another time, because even as you speak about, your perspective and the criticisms you put out there, we have to face what's happening. And a lot of times investors, I think, have that blind spot. How often do you guys, see that for yourselves, and how do you make sure it doesn't get in your way?
Well, the best way to learn something is to be a victim of it yourself. And we have been a victim of this countless times in our careers. And you have to at least take a step back and say, what did I miss? And why did I miss it? And how could I get better at not missing it in the future? So for example, we totally missed the violence of the recovery from the depth of the COVID lows. The mania and speculation that flowed from people being basically locked in their homes and given money to speculate with, I think caught a lot of people off guard. And so then we did a lot of soul searching, like, why did we miss that? This was pre-Doomberg, of course. So luckily we don't have a long track record of having been wrong, but it caused us to miss it. And so anytime we make a forecast that doesn't turn out to be right, and we've made plenty, as anybody who is active, content creation business is a volume game, and you're going to get a lot of things right and a lot of things wrong. We always try to go back and say, hey, we thought this would happen and it didn't. What did we learn? And we try to be careful to say, like, in this case, like, we criticize the Inflation Reduction Act, but it is passed. Mm-hmm. And those funds are earmarked, and industries are being rewired, and in some cases re-onshored, because the Inflation Reduction Act, correctly, in our view, has an awful lot of incentives for, made in the USA, and to the point where Europe and others are crying foul with, international trade organizations, because it does reek of protectionist policies. And we would say that if Europe did that, we would be the first to complain about it, we being the US, which is where we're based. But having said that, all those pieces are on the board. Like, that act is passed. There's also benefits for traditional energy companies, fossil fuel companies. There's a huge benefit for carbon capture and sequestration, which is something we've written about. And there's a few companies in the space that seem primed to take advantage of that. There are some benefits for nuclear power, although we've written with some frustration about how the US government basically does everything in its power to stall that industry. But the main point is the deluge of cash is coming. It's going to be spent. What does that mean for, interest rates and deficits and deficit spending and all of those things? But we're talking hundreds of billions of dollars, which is bringing a proportionate amount of co-investment, because many of these funds require co-investment. So the full size of the effort, which we think is foolhardy, to rush away from fossil fuels into intermittent power sources, that experiment's going to get run.
Yeah.
And it will have all kinds of consequences. Trying your best to understand the is state makes you more likely to be able to have a good shot at understanding the consequences. And so we're not in denial on that point. And it is real, and it's coming. And you're going to see battery plants and wind turbine plants and huge amount of investment in re-onshoring a solar industry that we foolishly gave away a decade ago, which we participated in our professional lives, as China basically stole that industry from the West. It's coming, and it's real.
Yeah. Hard truths sometimes to look at, and I think that's part of what investors really need to get comfortable with, are the hard truths, because it's going to affect their portfolios if they don't look at those hard truths. And that's part of what I think your magic is. You force us all to be with those hard truths, because they're reality. Yeah. Like, we may not like it, but this is the reality, people. And you all do a great job at doing that. So thank you for it.
Yeah, appreciate that.
Yeah, it's the truth. What is your current research showing with regards to just the timeline of this bear market? What does the research indicate regarding, if you can predict, its length? How much longer?
Sure. So I would say there are indicators, macroeconomic indicators, that smarter people than us have used for a very long time that seem to be flashing significant danger for the economy. And we seem to be at that period where I heard this analogy on a podcast, and I wish I could credit it, but I'll use it. We're in that period in between where the grenade pin has been pulled, but the grenade hasn't exploded yet. And the market is beginning to wonder whether maybe they've gotten away with all of this. And it's possible that the grenade is a dud. But historically, the error rate on grenades is pretty low. And so, but we're in that period where, between when Bear Stearns collapsed and when Lehman collapsed, there was this period back then, and we lived it as, corporate executives where, hey, maybe this is okay. Maybe this is contained. Maybe subprime is contained. It was a very long time between those two events. And as time goes on, we tend to group them together and assume this was all part of a rolling crisis. But it was not it was a simmering crisis. And the market, perhaps got a little complacent that this is in fact, hey, subprime's a small part of the market and housing prices always go up. And yes, a couple of hedge funds at Bear Stearns and eventually led to the toppling of Bear Stearns. But then when Lehman collapsed and AIG, needed to be bailed out and the rest of the crisis really, contagion really exploded, we would say that the pulling of the pin on the grenade was Bear Stearns. And then the latency before the explosion, the big question before everybody is that the case today? And by the way, if that is the case today, then inflation will be short-lived because we will see, a collapse in economic activity, which necessarily reduces pressure on labor, which is one of Jerome Powell's fixations. We shall see. It's Doomberg, so we would be probably in the bearish camp. We are professional defensive pessimists. We spend a lot of time thinking about worst case scenario risk and hedging ourselves accordingly. But I do fear, part of me fears that, you can't go from mortgage rates of sub 3% to 7% on the way to 8% in less than a year and not expect significant repercussions in the critical aspects of the economy. Having said that, you do see some counter indicators, like the used car prices are spiking again, and you see all of these sort of anomalies. So it's a very difficult thing to ascertain whether we've got a dud grenade. But I would say that is the big question. And I would say at the first signs of a true explosion, that is the best time to reposition when you know for sure that it's coming and the market hasn't fully internalized it yet. I had joking with a few friends, like the market always underestimates bank runs, and we're seeing one with some crypto banks. And our view is like the best time to get in on that trade is after all the bad news is out, but the bank hasn't yet collapsed because it's very hard to stop a run. And so you want to press certainty as opposed to predict whether or not a run will start. Here, there will be time if the economy explodes for you to reallocate, but we would be aggressively doing that in that scenario.
If you want to find Doomberg, please go to doomberg.substack.com and of course on Twitter, DoombergT. Why don't we take some questions, Mark, because I'm going to presume there's plenty in the chat box.
All right, Kim, thank you so much. Thank you so much as well, Doomberg. We had a viewer here. They're wondering, do you see that the U.S. is doomed because of China and Russia and other nations starting to de-dollarize due to U.S. weaponizing the dollar, printing funny money?
I would say that the U.S. is a long way from doomed. The U.S. has a lot of inherent advantages, including the U.S. dollar, which is still widely considered to be the reserve currency in much of the world where the economy is vibrant. And that is, I would say that weaponizing the dollar does not come without risk, and there will likely be consequences to doing so. But if you're positioning your portfolio for the collapse of the US or the collapse of the US dollar, we would say you're probably a bit early on that trade. But that's just our view.
All right, brilliant. Thank you very much. We had another viewer here. They're wondering, is it a good time now to start looking at diversifying and investing in Chinese ETFs?
We would consider China to be uninvestable. That's just our view. That's not a recommendation. We live and transact in the US dollar world. And I would say that, as we mentioned earlier, if you're talking to a Western analyst who claims to be an expert on China, you're probably talking to somebody who has a bit of overconfidence. And we would stay far away from investing in in China directly or indirectly through ETFs, or worse, through ADRs, which are really nothing more than certificates in the Caribbean. Lots of people make lots of money doing that investment, and if you think you could be one of them, go for it. But for us personally, there's, as my friend Tony Greer, who runs TG Macro, would say, there's 100 better investments on the board than that.
All right, thank you. Another viewer here, they're wondering, with the recent string of U.S. layoff announcements, is that a precursor to something much bigger?
So you have to look at where those announcements were made. They happen to overlap with a lot of the stocks that were darlings in the recent run-up, which can give you perhaps a distorted view of the consequence of those layoffs. Our channel checks in the traditional industry is there's still pretty solid labor shortage in the sort of the physical companies that make and move stuff. There's still, pretty solid demand for labor there. But if you see layoffs at Amazon, or you see layoffs at Google, or you see Facebook, the FANG stocks, then of course, since they were such a high proportion of investor mind share for so long, you can imagine that this is foretelling something perhaps more serious. Now, that answer might run counter to our question as to whether we are, we've pulled the pin on the grade, but it hasn't exploded yet. But that data point alone is not conducive to drawing a conclusion in our view, and we would need to see confirmatory evidence in other sectors before we would be willing to press that conclusion.
All right, thank you. Another viewer here, they're wondering if they are looking at diversifying globally, what countries would be best to lean towards?
In our view, we would limit our investable universe to Europe, the US, and Japan, just because, again, we're all in on the US dollar system. We're paddling in the canoe. We might not like the people that are dictating the way the canoe is being paddled, but we're not switching canoes. And so that's not probably a question that we would be most qualified to answer. And when we're not the most qualified person to answer, we like to say so and refrain from doing so. But we limit our investable universe. And in particular, by the way, we do a lot of private investing. We do very little in the public markets for a variety of reasons, which is something, this is an accredited investor conference. I would be remiss if I didn't say that our investment strategy is that we earn money in fiat, we save money by buying real assets, and we invest privately, especially where we can personally impact the outcome by getting to know the management team, bringing our expertise and network and skills to bear, and create our own sort of sweat alpha. And so that is something that many retail investors can't do, but accredited investors, if you can find the right private deals, especially in an inflationary environment, companies with pricing power that have easy access to leverage and the ability with cash flows to pay down that debt and to refinance. Debt is a great hedge against inflation, especially if the product is needed. So some of the old school businesses that don't get a high multiple on Wall Street and are best held in private hands and pay great dividends, those are the types of plays we look for at the right price in the private market. And we do very, very little in the way of actually public stock investing ourselves.
All right, thank you very much. Well, Kim, that puts us right at time. Any closing comments?
I'm just grateful, Doomberg, that you and your colleagues are giving us the hard truths, because those are necessary for investors to be successful. So thank you for existing, coming together, and sharing all your knowledge with us today.
Thank you so much, Kim Ann. Like I said before, big fan of your work, and I really appreciated the discussion. It was a great time. Thanks for doing it.
Thank you. Thank you, Mark, too.
All right. Thank you so much. Thank you, Doomberg. Thanks for taking the time out. We hope to hear from you again very soon. And a big thank you to all those in attendance today. You're watching Money Show's virtual expo for accredited investors. We were speaking with Kim Ann Curtin, the Wall Street coach, and Team Doomberg. You just heard from Doomberg himself. So thanks a lot for being here. Stick around. We have more great content coming your way.